Hello, my name is Anthony Sicaro. I'm founder and president of Providence Financial and Insurance Services located in the San Fernando Valley in Woodland Hills, California. I'm also host of the Providence Financial Retirement Show, which airs every Saturday on AM 870. KRL Lays the Answer. And I'm an estate planning attorney as well. And I do these videos primarily for my clients to keep you informed of what's going on in the economy and my thoughts, along with the thinking of the money managers, sound income strategies that is working very hard behind the scenes. So if you're a client of mine, thank you for your business. Thank you for your trust. You know, I don't take it lightly. If you're not a client of mine and you have any questions about what you see, then feel free to call us. And you can probably best place to get our contact info is right from our website providencefinancialinc.com. Providencefinancialinc.com. So, oftentimes, the way that I decide to do these videos is based on questions that I get from clients. And if several people ask me the same question, then I kind of know that a lot more of you are probably thinking the same question, even though you haven't asked it. And I think three or four times in the last week, or maybe even two, I've had a question from several different clients that has to do with why is there so much cash in a client's portfolio, in your portfolio? And we talked about this in the last video that I did because it's something that we intentionally are doing, but that was a while ago. So I felt compelled to answer that question again and just bring you up to speed with where we are. So I want to do a quick market update, give you 2 minutes worth of my thoughts, and then I want to talk about why you have so much cash in your portfolio. And then we're going to throw some other ideas out there towards the end of this video about what you can do if you don't want to have so much cash in your portfolio. So first thing is quick market update. The market volatility has been with us now for a couple of weeks. We've had multiple 100-point day swings on the NASDAQ and the Dow. And that often happens when markets get to resistance levels. So you've got resistance levels and you've got support levels. When a market grows and hits a resistance level, then there tends to be a lot of volatility around that level. And if it breaks through that level, then then it's got potential to grow, and it can even continue to go up dramatically if it breaks through that level. Same thing with support levels. If it goes and it breaks through the support level, then it could continue to go down. So resistance levels and support levels are just important to keep an eye on. They don't tell you a whole lot, except you kind of know where you are in the market. And right now, the NASDAQ and S&P 500 are at the resistance. NASDAQ actually broke through the resistance level, I believe, a couple of weeks ago when when it hit the record high and then just kind of continued going through it. Might have actually been a little longer than that. The Dow is coming up on the resistance level, and the S&P, I think, is right at the resistance, maybe a little bit above it. But what's that tell us? We don't know. I mean, if there was some magical formula or silver bullet that let us know exactly what was going to happen, the reality is that we would all be doing it. So we don't know. But here's what we do know is that oftentimes when you get to those resistance levels, it creates volatility. That seems to be very common. That's why we're having a lot of volatility now. What the end of the story is, we'll know in a month or two or three, right? So we just can't say now. But important to understand. Now, let's talk about the cash and answer that question as far as why do you have so much cash in your portfolio? Well, there's a couple of reasons. Number one is that the overarching theme of why we have the cash or why we are leaving so much cash in your portfolio is because we're waiting for a better buying opportunity. Some of you know that I've written a book that's going to come out in December. And the last chapter of the book, which I just finished a few weeks ago, maybe a month ago, it's called A Foretaste of the Aftermath of COVID. And I talk about the fact that there's a Grand Canyon sized gap between economic reality and the stock market. The economy is in horrible condition and the stock market is at record highs. And there's this big chasm in between. And I recorded a video a month ago about this. If you want to learn more about the difference, go watch that video. So I'm not going to reiterate what I talked about here, except to say that there's a big canyon in between economic reality and the stock market. And really, I think one of two things is likely to happen. What the government wants to happen is they want they want that the economy to grow into the stock market so that the stock market never really never really retraces. That's what everybody is hoping. But the alternative is that the stock market might retrace to match the economy. But something's got to fill in this gap. They can't stay separated like this forever. So we believe, and the more you watch some of the economists and analysts out there, the more you read some of the things out there in the Wall Street Journal and Barron's and some of the more credible authorities, the odds are in favor that the stock market is going to retrace to meet the economy. And so we want to be prepared for that. We were unprepared last time. Everybody was unprepared last time. No one expected that the world's businesses were going to be shut down generally overnight, and that the market would drop 37% in 37 days. It was the fastest drop we've ever had on record. And so the reality is no one could do anything about it. And professional money managers couldn't do anything. Retail money managers or retail investors couldn't do anything. Institutional investors couldn't do anything. It all happened so fast that it didn't give anyone time to react. Well, now we don't expect that the next retrenchment will be in the same manner. There has to be another major shocking event in order for us to lose another 37% in 37 days. But when you look at the history of market cycles, it's not uncommon for the market to decline over a period of between 1 and 3 years. Very common where the market will kind of drop like a feather falling out of the sky. If you imagine a feather falling out of the sky, well, it's going to catch an updraft every now and then it's going to go down a little bit, and then another updraft. But the reality is that the general trend of that feather is going to be down, right? It's going to be down. And that's kind of the way that, whew, excuse me, that's kind of the way that the market is generally going to be a downward trend, although there are going to be times when it comes back up. So it's not uncommon for the downward trend to occur over a 1 to 3 year time period. So we're not expecting another major category 5 hurricane like we had in March and April, but we are expecting a general downward retracement. Again, will that happen for sure? We don't know. We're just playing the odds. But we believe that it's more probable than not, more likely than not, that that happens just based on everything we have. And you can read about that, Google it. A lot of people are thinking the same thing. So, how are you going to take advantage of that? If that's what happens, how are you going to take advantage of another retracement in the market over the next 1 or 2 or 3 years, possibly? The only way to take advantage of that is if you have cash on the sidelines. That's the only way that you can buy low and sell high. Now, you know that we're investing most of your portfolios for income. So we're not trying to buy low and sell high, right? We're trying to invest for interest and dividends. That's absolutely true. But the portfolios of interest and dividends still fluctuate as well. So if we have a choice of investing you for interest and dividends and we can buy low and get you a higher yield, then we're still going to do that. So we're not trying to trade your account, but we've had this major financial shock. Your portfolios dropped substantially and then came back. Some of you are all the way back. Some of you are not quite back yet, but a lot of you have bounced. And if that happens again, we still want to have some cash on the sidelines to be able to buy at a lower price. That is exactly why we've got some cash on the sidelines. Now, normally we like to have some cash anyway, because sometimes a deal comes up that's just too good to pass up. And this is even in good times. So it's not uncommon for you to have in normal times 5 to 10% cash. Just because if such a deal comes up, we want to be able to invest you in it. If there's something in your portfolio we want to upgrade, then we have to have cash to be able to do that. So 5 or 10% is just kind of commonplace. Most of you now have between 15 and 25%. Okay? So it's higher. And some of you have asked me, why do I have, or how do I have so much cash? You understand the idea that why we want to have cash because we need to be able to be an opportunist later. But how did we get so much cash? And the answer for that's a little different for all of you. Some of you have had investments that, like bonds, that have been called. So when a bond calls the investment, that money goes into your cash bucket. There's been some preferred stocks that have been called, not a lot, but a couple. That goes into your cash bucket. Now, not all of you have the same investments. So you might have had a bond in your portfolio that was called that someone else did not. So that means you're going to have more cash than someone else. BDCs, business development companies. I put out a video, I think it was maybe 2 videos ago, where we talked about the fact that I made an executive decision for my clients across the board to liquidate half of the business development companies across the board because that is what fell the most between March and April. Some of the BDCs went down 40%, some of them, I think, even a little bit more than that. It really was more than we expected, but the opportunity is there is that we got most of that money back. We liquidated half of them across the board so that we've got some firepower. So if that happens again, we can buy at a lower price and come out smelling like a rose. So the reality is you've got extra cash because of this. So you all have excess cash in your portfolio now, somewhere between 15 and 25%. And that's why the big picture is the fact that we want to be able to invest later at a lower price, but some of you have more cash than others for the reasons that we just discussed. Now, some of you have asked me, do you have to have this much cash or do you have any say so? And I want to remind you that this is a collaborative process. Every single one of you and I have had conversations about what you're going to invest in and how we're going to invest, and we've made decisions together. I'm an educator. Yeah, I love sharing my thoughts with you, sharing my heart, sharing my feelings, and then together working with you to come up with decisions. So this is not a my way or the highway situation. Just because there's 15 to 25% cash now in your portfolios doesn't mean it needs to stay that way. Some of you have said, well, I'm not making any money on my cash, and so I'd rather reposition to something else where, I can actually try to make a little bit more. And by the way, I want to address that for a second. For those of you that feel like you're not making any money on your cash, that's really not true. And let me explain what I mean. It is true that you're not earning any interest on your cash. That's true. But if the investments that we're going to invest in drop, if your portfolio drops in value, which by the way is the only way that the investments are going to drop is your portfolio has to drop with it, then we're going to take that cash and reinvest at a lower price. So if everything dropped by 10% and we can take your cash and get a 10% discount on the stuff that we're going to buy as opposed to buying it right now, then check this out. You made 10% on your money while we waited. And it's kind of counterintuitive, right? It's almost like it's counterintuitive that you don't want your portfolio to drop. Well, guess what? How are you going to buy low if your portfolio doesn't drop? If you want to buy homes, right? If you have a portfolio of houses and you've got cash to buy another house, in order for you to get a discount on that other house, the rest of your houses have to drop. But as long as you're collecting your rent on those other houses, you don't care, right? So the reality is it's the same thing. The investments in your portfolio have to drop in order for us to be able to take that cash and reinvest at a lower price. But you're telling me I don't want it to drop. Why? I know it's kind of counterintuitive. The best thing that can happen is your portfolio comes down in value, because remember, your income stays the same, but your portfolio comes down in value, and then we can reinvest at a lower price. So when it comes back up, you come out smelling like a rose. So it's counterintuitive, and it's the same thing when you have excess cash and you feel like you're not making any interest. You feel like, well, it's just sitting there. No, if the investments come down by 10% and then we reinvest, you made 10% on your money by waiting, by sitting in cash. So it's the story's not over. This is a continuing storyline that's going to go on. We don't know what's going to happen, and that's not without risk because maybe it doesn't drop again. Again, odds are that it will. Nothing in the world of stock market, bond market, income producing, real estate, nothing in any investment world goes straight up all the time or straight down all the time. It just doesn't happen. It's this rigorous up and back and forth zigzagging type of situation with any investment. So odds are we're going to have another retracement. That's what we're banking on. But there's a risk. What if we don't? All that being said is the fact that by sitting here, you are making cash or interest on your cash. It's just not the kind of interest you can see if we go and buy in at a lower price. But what if you don't like that idea? Right? What if you want to see some interest and dividends coming in now? Is there something you can do about it? Do you have any say in that? The answer is yes, of course, absolutely. And we've made some changes to some of your portfolios as a result of this. So there's a couple things we could do. The first thing is we can just invest in more of the same. So instead of leaving 15 or 25% of cash right now, we can agree that we want maybe just 5% cash, and we could reinvest the rest of your money as is the rest of your portfolio and income producing stuff, and we can focus on getting more interest, getting more yield. We can absolutely do that. Now, I will say that interest rates have come down, so it's harder to buy things today. Interest rates are probably a full percentage point off of some of the investments that we were getting 6 or 8 months ago. So if you've got a portfolio that's established with us, then the older investments, the older investments are still getting good interest rates. But if we're going to take some of this cash and reinvest it into bonds, your current bonds might be paying 4.5, maybe even 5%. You're not going to get that with new bonds today. You might be getting 3.5, 4% with new bonds today. So we have to consider that as well too, because rates are down. It doesn't affect your existing investments, but it will affect you going forward. So we'd have to talk about, how are we going to do that? And a lot of our clients, and my recommendation across the board, is really to hold off on some bonds because they're just a little lower than we want at this point. And maybe we substitute them for preferred stocks. You can still get good preferred stocks in the high fours, low fives. And it's not a bad alternative. It's a good alternative without a lot of additional risk. So bottom line is, on a conversational basis, you and me, we can have a call about, do we want to invest some of this excess cash now? And if you're getting impatient, we can do that. No problem at all. To your money. I'm just the coach. The other thing that some clients have wanted to do is they've actually wanted to get some money into equities. They've seen the market run up. The NASDAQ has run up. They're not going to need the money for a long time, so they don't care about any short-term volatility. And they actually want to put their money into equities. And we have two equity portfolios. There's different things you can do. There's a growth equity portfolio, but for those of you that need the income, we've got an equity income portfolio that's yielding more than 4%. So for some of you that are saying, I don't mind taking the additional risk, I still want the income, but I also want the potential for growth too. I don't have a problem if you want to put, 10 to 20% or something like that into an equity portion of the portfolio that's still going to give you a 4% dividend. That's another alternative as well too. So I'm just saying that there are some choices. This is not a my way or the highway. If you're starting to feel like there's too much cash for too long, and again, that's a question I've gotten from some of you individually. That's why I'm doing this video. Call me. Let's talk about it. Let's figure out, what do we want to do. Maybe we put a time frame on it. Maybe we say that, if a better opportunity hasn't come in 3 months, then we'll do it. So we're not just open-ended. Right now, we're pretty open-ended because we don't know what's going to happen. So that's what I wanted to share with you. I hope this video has helped. Certainly, if you have any questions about anything you've seen, of course, if you're a client of mine and you want to talk about this, get on my calendar. Be patient with me. Anytime I do a video like this, oftentimes we get a lot of phone calls and I wind up calling people after hours or weekends. So, so let me know, and I'll find a way to get in touch with you, even if it's on my way to or from the office. We can do that as well too. If you're not a client of mine, you want to learn more, providencefinancialinc.com. That's our website. Thank you. God bless.